Okay, good evening, everyone. Welcome to our webinar. This is the second part of the series on how to buy a house in Manitoba. The topic of tonight's session is financing, information that you cannot afford to miss, with Viktor Schaefer. He's our presenter for today's session. Victor is the owner of VS Solutions Incorporated, which employs a team of 7 mortgage and 3 insurance specialists. He has over 20 years of experience in financing, and Victor also has a great deal of experience helping new immigrants obtain financing and is very familiar with the new immigrant program. He is fluent in Russian and German, and please help me welcome Victor. And I'm passing over to him, and we look forward to your presentation. Okay, I stop sharing my slides. Victor, you can share your slides and start the session. Thank you.
Okay, so looks like I'm ready to go.
Yeah.
Excellent. Yeah, good evening, everyone. I'm definitely honored to be part of this presentation here. And yeah, I'm not gonna say too much about myself. I think the easiest way, if you wanna know more about myself, you could just go on Google and type in my name. You will get all the information you need. Because I think it makes sense to, to read what other people say about somebody and about my status and about what I do. So I always say to my clients, just go on Google, type in my name, and you get all the information possible you can find about myself. Today, I just want to give you a warning. I'm going to talk probably very, very fast because I'm trying to fit in within 45 minutes what I usually do with this within 3 hours. So in general, if I do my seminars, I have 3 hours time, but in this particular case, Margarita gave me only 45 minutes, so I have to behave myself pretty good today. Okay, before I will start the presentation, I want to make sure that there's a disclaimer. I want to make sure that you understand that everything I present today is my own experience, and you should do your due diligence and maybe, do a research to make sure that information provided here is applicable to you or not applicable to you. So for me, it's important that I share the information from my experience, but again, I want to make sure that everybody should do their own checks and take a look at the internet, what else is available. So I'm sure the information is 100% correct, but I have to do this type of a disclaimer. The first topic I would like to talk about is the credit history. It depends which country you came from, but this is one of the most complicated areas, I guess, for the newcomers to understand. There are some areas or some countries like UK, United States, they have similar system to Canadian system, but in most other places they don't have this type of a credit bureau or credit history. Like I'm originally from Germany, and we had also a credit bureau, but the information you usually could find at credit bureau there was negative information. So if we pulled the bureau and there was nothing, we were happy. If there was something, usually there was something negative. In Canada is a totally different story. The lender is reporting every month information to the credit bureau, and before they will make a decision, yes or no, to your request, they will pull your bureau, and based on information they will make a decision. So the credit bureau is really for the lenders like a Bible. That's why it's so crucial if you come to Canada that you understand how the credit bureau works. It's also very important to understand that the credit bureau system changes. It's ongoing change. So whatever was the right or proper information, let's say 3 months ago, is not, or 3 months maybe it's too short, but let's say a year ago, it's already different today. So that's why it's important for you to keep up to date and continue to research how the credit bureau works at the particular situation. So we have in Canada 2 different credit bureau. One of them is Equifax, second one is TransUnion. Equifax is more important, and TransUnion is also important for the lenders, but we're paying more attention to Equifax. The most lenders actually checking both credit bureaus. So now, the quality of your credit history is based on points. We call it credit score. So in this particular case, so in Canada, we have the lowest is 300, the highest is 900. But whatever is above 680, we consider as a good credit history. Okay, so don't be disappointed if your credit score is 700. It's actually a great score. As long as it's above 680, we consider you as a good client. So now, how can you improve your credit bureau, or how can you establish a credit bureau? Because quite often I talk to our clients and I check their situation, and I do see that they have a credit score, but the credit history is not good enough for the client to get the best deal on the market. So what is important for you? First of all, if you come to Canada or if you're already here, you have to have 2 different traits, which means just 1 credit card will not be sufficient. So it should be maybe 2 credit cards, or it could be a credit card and a line of credit. I'm against car loans because this is a short credit history, because whenever you pay out your car loan, it stopped reporting. That's why I don't really support some kind of a loans, because I know that banks offer clients loans by saying, look, if you get a loan, you can establish credit history. I'm against that because you can establish it for free. So you don't need to pay for a credit history. So very important is to have 2 traits. Just 1 credit card is not enough. And it's also important to have a credit card with a higher limit. So it's like, $500 credit card is not sufficient. The lenders like to see $2,500 and more. Now, it's also important to have separate credit cards, which means if you are married, it's very important that you and your wife has a separate, or in my case, I say, because I'm a man, I say you and your wife, should have a separate credit cards. Because if you have a joint credit card, quite often the lender is reporting under only 1 name, which means whenever you decide to apply for a mortgage, it is possible, or for a line of credit or something else, that one of you will not have a credit history. So that's why make sure if you talk to a lender, make sure that they're reporting to a credit bureau separate. The most secure way is just that you apply for a credit card and your wife or your husband applies somewhere else. Then you know for sure that your credit history will not be reported joint, it will be reported separate. It's very important that you will use a credit card at least once a month. Why is that important? Because the credit bureau pays attention to so many details, and one of them is they want to make sure that your credit card is active, which means, let's say you have 3 credit cards and you use each credit card once a month, then the credit bureau knows, okay, you have access to actually a high amount of money, but you can control your behavior and you use only a certain amount of your limits. That's exactly what the credit bureau likes to see. If you have 3 credit cards and you use only 1 and 2 other credit cards are not in use, then there is no guarantee, you don't use it because you don't have to, or maybe you don't use it because you lost them. So it's very important that you will try to have at least 1 transaction per month. It doesn't matter how big the transaction is. It could be $1, $10, doesn't matter, as long as you have at least 1 transaction per month. Crucial for your credit history is to pay on time. When you get your credit card bill, usually there's a grace period, 20 days. You don't have to pay right away, but make sure you pay on time. If you don't pay your credit cards or anything else on time, it's affecting your credit bureau, and it's affecting a lot. 35% of your beacon score is based on how you do your payments. It's very important that you will pay your bill at least 1 day before due date. If you get your credit card bill, again, you have a time frame. I don't recommend to pay it from the day 1. Why would you pay? And why wouldn't you keep the money in your account? Why wouldn't you make money on your saving account? But just make sure you pay 1 day before. Okay, if you pay 1 day before due date, everything will be great. One of the options is just set it up online that 1 day before due date, the payment will be done automatically, and you will not be worried about that. It's very important that you will not max out your limit. So if your limit is $2,000, you should try to stay maybe around $1,000. The lowest amount is better. So let's say you have a $2,000 limit and you use only $300, great. Try not to go above 70%, because 70% is really a critical limit. That's where your credit history will get affected. Try to be 50%. Again, 30% is even better. As long as you will not go above 50 or 70%, you will do well. Why is that important? Because the credit bureau assumes if you use your credit card too much and you're getting too close to your limit, that you're probably in trouble. And even if you're paying out your balance every month to 0, it still makes sense not to go above 50 or 70%. If you have to use such a high amount, just increase your credit card limit to $5,000, and then you can use the $2,000 and everything is back to normal. You know, one of the mistakes that lots of newcomers do, not just newcomers, and guys, just so you know, lots of newcomers actually know more about credit history and credit cards than lots of Canadians. Why? Because they're attending the seminars, they're attending the webinars, and they're actually eager to learn. And what I see quite often, that clients closing the previous credit cards. The credit card was in effect maybe for 10 years. And then for whatever reason, they got a better credit card, they're closing the old one. It's not a good idea. Your credit history is based not just on how and when you paid your credit card bills, it's also the time frame. So you should have it as long as possible. So if you have a credit card for 10 years, if you don't want to use it, just don't use it, but don't close it. Okay, so the length of your credit history is 15% of your credit score. So pay attention to that. My recommendation is never to close your old credit cards. You don't have to use them if you don't want to, but don't close them. It's very important that you will not have any issues with utility providers like, or telephone providers like Rogers, NTS, Hydro. Why? Because if you don't pay your bills on time, they will report to your credit bureau, there will be a collection. Even if it's not your fault, my recommendation would be pay it on time, and then you can argue with them. Because if they will report a collection in the credit bureau, it's going to stay there for a long time. It's going to be there for 7 years. And again, even if it's not your fault, it's very difficult to remove it. From my own experience, I can tell you, it's pretty much impossible to remove it from a credit bureau. So my recommendation would be, if you have a disagreement, pay the bill, and then continue to fight and get this straightened out. But make sure there will be no delay in payments. It's also important that you will not shop around too much. Why? Because every time you apply for a credit card or a car loan or a mortgage or something else, the person who is dealing with you is going to pull your credit bureau. Every time somebody checks your credit bureau, your credit score goes down. There are some changes which I will talk about in a minute, that this will not be so critical in the future. But still, if you apply for a couple different credit cards at the same time, it's going to affect your credit score. Why? Because the credit bureau just assumes you're in trouble. You're trying to help yourself by adding additional debts, and this is not something that the credit bureau likes to see. So if you shop around, or if you're applying for a car loan or credit cards or so on, don't do it at the same time in a short period of time. Maybe spread it a little bit, and then you will not have any issues. So there's actually, now it's not will be, it's already the case. Starting June 1st, there are some major changes in the credit bureau. And one of them is, if let's say you had 5-6 different financial institutions who checked your credit bureau, in the past, it did affect your credit score for 36 months. Now, starting June 1st, it's affecting you only for 12 months. So if you really had a bad car salesperson who shop around to get you your car loan all over the place, and your credit history was checked like 30 times, it's going to affect you only for 12 months now, and not like for 36 months, how it was in the past. Also, if you shop for a mortgage, in the past, if you shop for a mortgage and you go to one bank and another bank and a third bank, just because you're trying to compare the interest rate, it's actually, it did affect your credit score. And they're changing it now. If you shop around for a mortgage in a short period of time, it's not going to affect your credit score. So you can visit a mortgage broker, you can go to a bank, or you can go to a credit union, and it's not going to affect you so much. In the past, it was 14 days time frame. Now they extended it to 45 days. There's lots of time to shop around, but you can also see a mortgage broker, and they can do it on your behalf, and then you don't need to shop around, and it doesn't cost you anything. Bankruptcy. That's the worst thing what you could do to yourself, to declare bankruptcy. There are some situations which is not up to you. One of the most popular one, unfortunately, is divorce. If people getting divorced, nobody wants to pay the bills, and it goes to the bankruptcy. The other one is the person lost a job. The third one, the person has health issues. So there are some situations where you have really no control about that. But I see too many people declaring bankruptcy too fast, and this is bad. Bankruptcy is not good for you. It will be on your credit bureau for 7 years, but even after 7 years, it is a public information for your whole life. So if you apply for a certain position, people are actually, or the employers, checking credit bureau or checking public information, and if you declare bankruptcy, some of the employer maybe will not hire you just because of that. So try to prevent this as much as you can. And there are some other tools which I have no time to talk about. So just try to prevent this step. It's not a good solution. Just to summarize the credit history is your payment history, like how, if you pay your bills on time or not, it's 35% of the Beacon score. How much you use your limit. If you have a limit of $2,000, if you're maxing out your limit, it's really not good for you. It's 30% of your credit score. Length of your credit history, which means if you have credit cards which are in power for 5, 6, 7, 10 years, it's great. Don't close them because it's 15% of your credit score. And if somebody checks your credit bureau, it's affecting you negative by 10%. And it's also very important to have a credit mix. What does it mean, credit mix? It's just to have a credit card is good, but it's not really perfect. The lenders like to see line of credit, credit cards, mortgages. They just like to see a variety of different debts. That's where they can really control you or figure out if you can control yourself or not. So I just mentioned already that starting from June 1st, there are some changes in the credit bureau, and one of them is I mentioned already that they're actually making our life a little bit easier, but it's also a disadvantage, specifically for newcomers. In the past, if you made a mistake or you didn't pay something on time, it affected a new person and someone who has a long credit history the same. Now it's different. Now it's affecting, if you're making a mistake or you're not behaving yourself properly in financial area, the mistakes will affect you a lot more than it was in the past. And the same if you have a great history, a long history, and you will do a mistake, it's not going to affect you so much. It's actually, I think it's fair. The direction that credit bureau is going, it's very fair. And keep in mind that the banks are relying on this information. So they're giving you tons of money just based on what they see in the credit bureau. And that's why it's so crucial for the lenders. That's why they pay lots of money to make sure that the credit bureau works well. And that's why credit bureau does all the changes, because they're trying to adapt to the situation, because the situation on the Canadian market is changing ongoing. So in the past, the credit bureau didn't pay attention to phone bills. They did report them, but it didn't affect your credit score. Now it will, so make sure you pay your bills on time, telephone bills. Mortgages, most of the lenders don't report mortgages in the credit bureau, and even if they do, it didn't affect your credit score. Now it will, starting on June 1st. If the lender is reporting your mortgage to a credit bureau, it's going to affect the credit score. I don't like the idea, but that's a different story. Then there's also now another big credit score which we are using, which pretty much forecasts your bankruptcy. And I will give you a bit more information just in a second. So now, if I talk to clients quite often, I hear this comment: I know my Beacon score. That's what I have. Why? Because every person has an option to go online and check your own credit score. In our industry, in the banking industry, we're not using the credit score the client sees. We have our own scores. And that's the one that you see right now. Like in this particular case, the client has 719 Beacon score. That's the score I use. The second score is the forecast more or less about the bankruptcy. So everything below 900 is actually not good. So in this particular case, the client is not in a good shape. So it's 864 Beacon score, which means he's actually, it is possible that one day he will declare bankruptcy. So it's not the best score that this particular person has. The third score is the forecast. What do they forecast? What will happen in the next 24 months with your credit score? It's very important for us if we do mortgages or loans, we're paying attention to this score, because it tells us if will the client improve or exact opposite, that his situation will get worse. And the last score, that's the score the client sees. And usually the score that the client sees in the credit bureau is higher than we use. In this case, for whatever reason, I'm just using a screenshot from one of my clients. Definitely don't see any names, right? I call this person John Public. But in this case, it's a little bit strange, but the score that he will see is actually lower than the score I use. And this comment I always say to all my clients: if you don't have any credit history, it's still a lot better if you have a bad one. So, but guys, whoever is watching this webinar right now, please understand the banks are paying attention to credit bureau. That's everything for them. And if you want to get the best deal on your mortgage, on your line of credit, on your car loan, make sure that you establish a good credit score from day one. And there's lots of banks who are offering now credit cards for newcomers that just came to Canada, and they can. It is possible. So, and if you have a question, you can contact me directly or just go on the internet and research a little bit. Now, the next topic, and according to Margarita, again, she gave me 45 minutes. So right now it's supposed to be a question time, but because we don't have time, I'm just going to the next topic. And I know it's lots of information, but yeah, because of the time frame, I'm forced to run through. Now, just 2 minutes ago, I explained you how important the credit cards are and why you should have a credit card. And now I'm going to talk against credit card, why you should not have credit card. So it's a little bit different information I will provide, but why I'm doing this. You know, for me, it's very important that the immigrants are not getting the same habits that lots of Canadians are in. They're in debt like crazy. And lots of people losing their houses, losing everything. There's tension in the family because they are in debt and they cannot handle their monthly obligations. So on my website or on my Facebook group, I try to provide as much information as possible to prevent that the new immigrants will get in a position that one day they will be in financial trouble. And believe me, 80% of newcomers are financially struggling because they don't control or they didn't have an idea how the Canadian system works. And one of the biggest traps that everybody can get in is credit cards. And that's what I will talk about now. So why people are getting in trouble? One of the reasons, they're trying to accumulate as much as they can, points or air miles, because this particular credit card offers lots of air miles and so on. What the clients do, they just, paying attention just that they can make a little bit money or get points and to buy something for this point. But the dangerous part of this situation is you get more credit cards, you start to use more, you get in debt, and you cannot pay them. So I even say here that nobody became rich by earning air miles and points, and this is 100% the case. So if you're doing it and you can control yourself, I have some people who are doing it on an ongoing basis. They're opening credit cards, taking advantages of it and closing them. It's not a good practice. I'm telling you, it's not a good idea. But some people are doing it, but the credit card company is getting smarter and they're trying to stop this because they don't like to be used. And I think it's not fair also to the credit card companies just to use them. Now, the other one is the cash advance. You're somewhere in the store or you're somewhere on the road and you need cash, you don't have it, you just take your credit card, go to the bank machine and take cash. It's a bad idea. Credit card is charging you very high interest rate. And they're charging you interest rate from the day you took the money. Even if you pay your credit card to zero, you still get charged interest rate from the day you took the money. Okay, so my recommendation would be maybe go back, go home, take it from your house, but don't take it from a bank machine. So cash advance is a bad idea. Now, the other trap that lots of people get into, especially newcomers, they got, the new house and they're happy, they need furniture, they're going to one of the places like Ashley or Bricks, and they see this great offer, buy this furniture and do not pay for 18 months. So great idea, looks like, but really it's not. Just because, you cannot afford today, you think that you will be able to afford in 18 months to pay for it, but lots of people don't. The reason why they offer this particular product, because 75% of people are not able to pay this full amount 18 months from today. And what will happen, they will charge you interest rate from first day, and that's not a small interest rate. We're talking about 20% and more. They will charge you from the first day until the day, and then the person is actually getting a very high loan from day one. So my recommendation would be, if you cannot afford to buy it today, don't buy it at all, because you will not be able to pay it off probably in 18 months. Now, this is also important. Lots of people do not know that if they have a balance in a credit card, if they don't pay the full amount, let's say you have a $3,000 credit card, you use $2,000. End of the month, you paid $1,990. So it's only $10 left. So you assume that you're just paying interest rate based on $10. No, you're paying the interest rate for the full amount, because credit card company doesn't have an option that you paid a little bit. What they're registering is it paid in full or not. So that's why it's so important, if you pay in full if it's possible. To be honest, I always say your first red flag should come up when you're not able to pay your credit card in full. That means you're getting in trouble. So my recommendation would be, and believe me, 80% of my clients I see, they're just paying the minimum payment. It's a bad idea. That's why the banks make tons of money. That's when you open your mailbox, there will be lots of envelopes. They offer you free credit cards and this and that. Why? Because they know that the majority of the people have balances they cannot afford to pay off, and they're making tons of money. We're not talking about 5%, we're talking about 20%, 25%, 29%. This depends which credit card company you have. Some credit card companies offer better interest rate, but only if you're a AAA client and if you're a good negotiator. But in general, you pay over 20% interest rate. Now, what's also important to understand, if you took money, let's say, from a bank machine, and you use your credit card, and then maybe you had a great offer from some kind of credit company who is offering you a money transfer where you can transfer funds from one credit company to this one, and you will pay 0 interest rate or 1% interest rate. Keep in mind, if you do your payments, the first amount that applied for is the lowest interest rate you have on your credit card. So if you transfer funds from one credit card company to another one and you pay only 2%, and you pay $1,000 in this particular credit card, $1,000 will not go to pay off your high interest rate part of your balance. It will go to pay your lowest one. So first you will pay off your 2%, and then maybe your purchases, which is 20%, and then maybe your cash advance, which is 27%. So keep in mind that the credit card company are very smart, and they will not apply. Some of them are really fair. They're at least applying, part here, part here, part there. But the most credit card companies, they're applying to the lowest interest rate balance first, and then they go to the next step. Keep in mind, the banks are not your friends. They want to make money. It's very important to pay at least 1 day before due date. So because if you don't pay on time, you will pay interest rate for the entire time that you use the credit card for this particular month. Okay, so 1 day before due date is more than sufficient. Now, here's an example of a credit card. I use this always in my seminars because I love it. Here's an example. This particular person has a credit card with a balance of $18,800. And what I do, I ask the audience, I'm just asking them, what do you think? How long is it going to take this person to pay off the credit card if he pays only the minimum amount, the minimum due amount? Okay? And then I get different answers, 10 years, 5 years, this and that. And here's the answer. And guys, pay attention. It will take 85 years to pay off this particular balance. So you will not be even alive to pay off this balance. So now the credit card company are forced to put this on your credit card bill. So next time you get your credit card bill, pay attention what it says on the bottom, and you will see how many years it will take you if you will pay just the minimum amount. And believe me, majority of people just pay minimum amount, which is not good. And again, this is one of my goals, to get the people who are connected with me or a member of my group or just or attending the webinars, seminars, that they are not getting in this trap, because it's very, very expensive not to pay your credit card bills on time or in full. And then I also ask questions usually during my seminars. What do you think? What should you do if you cannot control your behavior? Some people, they just cannot control money. They can't. You can give him $300 credit card and he will be in trouble, and you will give him $10,000 credit card and he's still in trouble. So then I always ask again the audience, what would they, what should be a solution? If you cannot control yourself, what should you do in this particular situation? And the answer is literally destroy your credit cards. But this is important. Keep in mind, I just talked about credit history. It's very important to have credit cards. Very important to have at least 2. 3 is even better. 4 is even better for the credit history. but for your pocket, it's not a good idea to have too many credit cards. So if you cannot control yourself, cut them, burn them, remove them. Just don't use them, but don't close them. The biggest mistake lots of people do, who are saying, I want to now start to control my expenses. I'm tired of it. I want to get out of the debts. Then just closing the credit card. This is a big mistake. Okay, it's affecting your credit history, and then you will get, a loan and mortgages for a high interest rate. You'll not really help yourself. Just get rid of them. And believe me, I cut many credit cards with a scissor in my office for my clients, because some clients, they cannot control their behavior. And as a person, if you work for the bank, you definitely cannot do something like this, because you can get in trouble, because that's what makes clients money. In my case, fortunately, I can allow myself to recommend to destroy credit cards. Now, but if you're in the position that you're already in trouble, you have lots of debts, you cannot pay them off, you're trying very hard, but really you're barely able to maybe pay your minimum due payments. So what you should do in this case, contact your credit card company and ask them to reduce the fee or an interest rate. And believe me, they will. If you put them under pressure a little bit, you can tell them that you're going to cancel this credit card, go somewhere else, they will lower your interest rate. I mean, if you're a good client, I mean, if you're a troublemaker, then I'm going to lower it. But if you behave yourself well, they will lower your interest rate. So that's at least something that will help you by paying less interest rate. That will help you to pay off your balance as fast as possible. Okay, there's no question. We're not doing any questions. Margarita told me not to ask any questions. We'll do it by end of the presentation. And I have lots of time, so I'm not sure how much time Margarita has and everybody who's attending the seminar or webinar. But yeah, the next topic I'm going to talk about, and again, guys, I'm apologizing for my speed. I'm just trying to cover as much as I can. The next topic is mortgages, because finally the webinar was set up to talk about buying a house. So we mentioned how important it is to have good credit history, because it's a direct relationship to your mortgage options. Now we will talk about the mortgage system in Canada. Since 2008, as we had a major financial trouble on this earth, there's lots of changes. And there is an organization called OSFI who controls the entire market. There's lots of new rules. And the mortgage rules are getting more and more strict. So the people are getting it's getting more and more difficult to get mortgages approved. That's why I recommend, if you want to buy a house, you should speed up, because it is possible in 6 months from today, the minimum down payment will be 10%. I will not be surprised. They're actively talking about us right now. So it's still 5%. We even have 0% options, but I think it's just a question of the time that there will be a minimum down payment of 10%. So my recommendation would be maybe to speed up a little bit. Now, what makes Canadian system different to pretty much the entire earth? Behind our mortgage system, there is actually a government insurer which protects the lender. So if something will go wrong, the lender is not really getting in trouble. Why? Because if they foreclose on a house, whatever the lender is losing, they're getting compensated by the government insurer. So this is a good thing and a bad thing. Good, why? Actually, thanks CMHC or some other insurer, we have two private insurer, Canada Guarantee and Generous, we actually in Canada prevented a major problem in 2008. The entire earth was in trouble. Lots of banks got support from government. Our Canadian banks were really solid. Canadian credit unions were really solid, and they didn't need any financial support, which is great. How long is going to be like this? I'm not sure. But one of the reasons was CMHC insurer or other insurer, because they didn't allow the banks to do what they want. So why is it good? Because you can buy a house with a low down payment. You can even buy a house with 0 down payment and still get the best rates. So they're not going to penalize you just because you have a lower interest rate. They will still get the same rate. Why? Because they have a protection from the government. The negative side is you pay for it. It's a one-time fee, and the fee is based on the down payment. So 5% down payment, you'll get charged 3.6%. It's one-time fee. Sorry. It's a one-time fee, so you don't need to come up with the funds. The lender will provide you with the funds, and they will put it on top of your mortgage, but finance still come from your pocket. If you put 10% down, you pay only 2.4%. If you pay 15% down, it's 1.8. And if you pay 20%, there's no fee. It's still on the chart, it still shows the fee, but there's a reason. I have no time to go in that. Today, I'm trying just to cover the basic and just the global rules, but there are definitely always some exceptions. Now, Why it's important to have a good credit score. Here you can see why. If you have a beacon score of 680, or some lenders don't even tell the beacon score because they don't see it. They just say A, B, C. So if you have a 680 beacon score and more, you can get a mortgage with 0% down or 5% down payment. If your beacon score is one beacon less than 680, you cannot have a 0%. You can, but it's a little more difficult. But there are some rules. The 678 or 680, they're so crucial because based on this number will be the answer how much you can qualify for. Your realtor will get the information, and with 680, you can buy a more expensive house than with 679. It's only one beacon score, but it makes a difference. So if your beacon score is between 600 and 679, you can buy a house with 5%, 10%, and 15%. If your beacon score is less than 600, it's actually not possible to get a mortgage with less than 20% at all. So 500, 990 beacon score, you cannot get a house with less than 20% down payment because 20% you don't need government insurance. That's why you can. If you want to do less than 20%, you have to have government insurance, and they don't allow to give mortgages to someone who has less than 600 beacon score. That's why it's so crucial that you, as soon as you come to Canada, or if you're already in Canada, whoever is watching the webinar, trying to establish good credit history as soon as you can. Now, just a couple of general rules. This is more for newcomers. If you come to Canada and you want to buy a house, and you want to buy a house with 0% down payment, unfortunately, doesn't work. 0% down payment works only for clients who are 2 years in Canada, 2 years in a job. Okay, 1 year in a job is also okay, but 2 years in Canada and 2 years credit history, okay, and good credit history. So just $500 credit card is not going to help. 2 credit cards, at least $2,500 limit, you can get a house with the 0% down payment. But if you're talking about newcomers just arrived to Canada, because we heard last week about, you can afford the house, you don't need to wait. And I want to continue this conversation here. You don't need to wait. You can buy a house with 5%, but there are some restrictions. One of them, it has to be a house for yourself. So you cannot buy a rental property. Second, you have to have a status in Canada. So you cannot be a visitor. You have to have PR or work permit. CMHC doesn't allow us 5% work permit, but the other insurer do. You have to be 12 months in Canada. Why it's important to be 12 months in Canada? Because I need references for 12 months. You need to prove that you paid your telephone bills or internet bills and your rent payment on time for 12 months. So that's why with 5%, you have to be 12 months in Canada. Minimum 3 months on a job, minimum 5% down payment, must be from own resources. Some lenders and some insurer allow gifted, but the majority request that the funds are from your own pocket, so they're not gifted or borrowed. And you also have to have additional funds to cover the legal costs, which you probably will get more information from the other webinars. But I always say 2%. 2%, lenders are asking for 1.5%, but we're talking about Manitoba, buying a house in Manitoba, because I do seminars across Canada, but this particular webinar is about Manitoba. So 2% from your purchase price should be sufficient to cover everything. I'm not going in details, how much the lawyer costs and land transfer tax and land title fee and all the other stuff. 2% from your purchase price should be sufficient if you buy a house below 350. If you buy more than 350, it could be more, because then you pay more on land transfer tax. Now, 10% down payment option is a little bit easier to get a mortgage. First of all, you don't have to be 12 months in Canada, 6 months is sufficient. But there is a maximum of 5 years. So if you're more than 5 years in Canada, you don't qualify for this program, because this is specifically designed for newcomers. That's why it's so important that if you're in Canada, that you establish credit history, that 2 years from the time you arrived, you will not be considered as newcomer anymore, because then you can qualify just on regular deals. You don't need to go with those special options. Again, 6 months in Canada, 5 years maximum in Canada, 6 months account statements. So make sure that your spendings and your account and your checking accounts are done properly, that you will not overextend, that you will not have checks written which you didn't have enough funds, because then you will have NSF. And that's exactly what the insurer looks for. They want to make sure that you control yourself and control your behavior. Minimum 3 months on the job. Now, what are the options to get a mortgage? What are the interest rate options? We have 3 different options: fixed rate, variable rate, and home equity line of credit. I'm not going to talk about home equity line of credit because it's we don't have time for it. But I will just discuss the variable rate and the fixed rate. Variable rate, advantage of a variable rate is actually lower rate. So you get a little bit lower rate. Not a lot lower, but a little bit lower. I'm not really a friend of variable rate because the rates are so low right now. Why would you experiment with a rate which can go up? So the risk is the rate can go up. And if something major that happen in Canada, it can go up by a lot. Do we expect that? No, we don't expect. But the risk is there. And if you want to apply for variable rate, you will not get the same amount approved for the mortgage because the government has some rules. And if we do variable rate, we have a more strict rules. So which means, let's say you want to buy a house for 300 with fixed rate, it works. With variable rate, it doesn't. Now, fixed rate. There's many different options, 1 year, 10 years. We even have 25 years option. Not the greatest option because of the rate environment. I recommend not to go above 5 years because then the rate is really expensive. Advantage of a fixed rate, that your rate is not going up for the period of time. So if the rates in the market will go up, because keep in mind, guys, we have the lowest interest rate in the last 60 years. So that's why it's so dangerous right now. And lots of people extending themselves, they're maximizing their limits. So which means that the rates will go up. It is possible that the people will start to lose houses. So, but if you have a fixed rate, you have a 5-year time. So if you see the rates going up, your mortgage will be due for renewal, let's say in 3 years, you can slowly prepare yourself, even up to the point that maybe you will sell your house before your mortgage is due for renewal. But I don't expect that the rates will go up a lot because of the economy. We are not doing well, and I don't think that the rates will go up in the near future. But if you have a 5-year rate, and right now the rates are excellent, so why wouldn't you look at it? Now, the downside of a fixed rate is penalty. And this is a very important topic I will talk about today, is the penalty structure, because lots of people think every bank is the same. It doesn't matter which I go. If I go to RBC, CIBC, Scotia, Credit Union, a mortgage broker, everywhere I get the same rules. No, the rules are different. And I will explain you why. Now, what are the options to get a mortgage from? One option is our 5 big banks. It's RBC, TD, BMO, CIBC, and Scotia. Then we have credit unions. In Manitoba, we have Crosstown Civic, Steinmark Credit Union, Cinnabon, Cambrian, Carpathia. There's so many different credit unions that you kind of get a mortgage from. Then we have monoline lenders. Those type of lenders you usually get through the mortgage brokers. Mortgage brokers have access to banks, to credit unions, but they also have access to monoline banks. And I will explain you the difference between those banks. And then we have trust and private lenders. I don't really want to talk about those guys. I hope you will never need money from those guys because private lenders are for clients who are in trouble. Now, mortgage penalties. If I talk to clients, I hear quite often, I'm going to die in this house. I'm going to stay in this house for 10 years because that's how they used to do it in their country of origin. We heard it in the previous webinar. That's how our parents were thinking. Canada is different. Nobody really stays in the house for a long time. There are many reasons why you want to move, okay? But if you decide to break your mortgage, there's a penalty. And the difference between penalty is huge. If you can port your mortgage to a different house, great. But in some cases, you cannot. And I will explain you why. For example, credit unions. Credit unions offer mortgages only in one province. So if you decide to move to Alberta, you will not be able to move your mortgage. So which means you have to pay a penalty, pay off your mortgage, and get a new mortgage somewhere else, okay? So there could be a reason like a divorce, clients getting divorced and they have to sell their house, they have to break the mortgage. It's not in your control, but this is a life event which can trigger a higher penalty. It could be health situation. Alberta, I have lots of clients in Alberta right now, they lost their jobs. They're forced to sell. They don't want to, but they're forced to sell. And there's a big difference in penalties. And we're not talking about small difference. We're talking about literally, like right now in Alberta, one client pays $5,000 and the other client pays $30,000. So we're not talking about small penalties, okay? So now, the minimum penalty is always 3 months interest rate. It doesn't matter if you do variable rate or you do fixed rate. That's the great option. If you did variable rate, you can get out cheap, okay? But now, I want to show you how to figure out which lender has higher penalties and which lender has smaller penalties. The easiest way, if you go on their website and you look at the rate screen, If they have only one column, that means that's probably a lender with a low penalty. If you see two columns, okay, I'm now going ahead, so I have to go back, but I will just continue. If you see two columns, then there's a danger that this particular lender offers a higher penalties. And I will explain you how the math works. Again, I apologize, I'm running here as fast as I can, so I hope that, but you know, because it's recorded, the beauty is you can listen again and stop it and go back, and you don't need to listen to my speed one more time. Now, here's an example. The client got a mortgage, $200,000 is outstanding balance. The interest rate that he got was 3.5%. It was a 5-year term, 3 years left. The rate today, if you would lock it in for 3 years, is 2.89. This is just an example, okay? This is an old example. I should adjust the numbers a little bit, but this is just an example. So what the lender will do, they will say, okay, you're breaking the mortgage, you're breaking our agreement, so there will be a penalty. This is fair, there's nothing wrong with it. But how the penalty is getting calculated? They're saying, look, your interest rate was 3.5. Today the interest rate is 2.89. So that means that we're losing actually money, and we're losing 0.61% interest rate per year. So in this particular case, it's $3,000 or $1,200. So because it's 3 years left, so we have to multiply it by 3. So in this case, 1,220, we multiply it by 3, and it's $3,660. That's your penalty with the low penalty lender. Okay? Now, here's another option. Here's a lender where if you go on their website and you look at their rate screen, you see that in this particular case, there's two columns. There's a posted rate and the best rate. Sometimes they don't even show the best rate because they don't want you to know. It's based on your knowledge. So that's why I always say, you know, don't accept what the lenders offer you. And that's the nature of my business. We are actually in process to negotiate the deal for the clients. But today we're talking about penalties. So why the second column is important? Look, and this is all our big banks that have the same penalty structure. RBC, CIBC, BMO, TD, Scotia. This is not a secret, maybe secret for the client, because if they don't know what's available, they just assume that this is normal. But all our 5 big banks charging very high penalty. So you don't even need to look at their website. I'm telling you, it's a high penalty lenders. And how their math works. The same situation, 200,000, 3.5 interest rate. Here is the difference. They're saying, yes, you got 3.5% interest rate, but our posted rate, the second column, was showing different. You were just a good client to us, and that's why we're giving you a better rate. We gave you a discount. It's supposed to be 5.5, but we gave you 3.5. Now, we'll continue. It's 5-year term, 3 years left. The rate today for 3 years, the same, 2.89. Now, if that would be a fair game, then we will again do 3.5 minus 2.9. But the banks are doing it a different way. They're saying, look, we gave you a special deal, but our rate was actually 5.5. So what they will do, they will take 5.5, deduct the 2.89, and suddenly we have a difference of 2.61%. 2.61%, it's a loss for the bank in an amount of $5,220. You multiply this by 3, you're getting a very high amount, which is $15,660. So you see that this makes actually a big difference. Okay, it's a difference between the penalties in amount of $12,000. It's huge, and it doesn't matter what the life event is. If it's a divorce or you lost a job, the $12,000, it's lots of money. That's why I always say, before you decide where you want to get your mortgage, pay attention to penalty structure. And I would give an example just with 200,000, which is really nothing compared to some mortgages in BC and other places. And this is public information. You can get it, you can find it, and this is not a secret. So I see that actually running behind my schedule, but Margarita tells me that's okay. So I will just continue. I'm not going to talk about construction mortgages because it will take me too much. One thing I can tell you, construction mortgage is lots of headache, lots of high risk. So before you do that, you should really consult and check all your options. Okay. So I'm not going to talk about construction mortgages anymore. I will just leave this because it's recorded. You could actually read the suggestions. The last topic I want to talk about is insurance. It's very important that you get proper insurance in place. Because, if something will happen, there's not much support from the government. The first 10 years, pretty much nothing. After 10 years, you get a little bit. So that's why I say, if you come to Canada, you should have two things. First of all, you should get a credit card to establish credit history. The second step, you should get insurance. Why? Because if you're young, if you're healthy, insurance is cheap and you can get a good coverage for your whole life. But there's a big difference, again, because today the topic is bank secret and what you should know. I'm trying to explain only something that nobody else talks about or not many people know about. And what I want to show you here is the difference between the options you get from the bank or credit unions and the option you can get from a licensed agent. And the difference is huge. And there's just a couple differences. Bank and credit union can insure only the mortgage amount, which means if you have a $200,000 mortgage, they will insure $200,000. Okay? You cannot choose. You cannot say, I want to get insurance for more. If I die, I want to make sure my funeral costs are covered. I want to make sure my family has more money. You can cover only mortgage amount. With a licensed agent, you can get the amount that you pick. The next one is the insurance coverage with the banks and credit unions is decreasing every month because your mortgage goes down. So you're insuring only the mortgage. So you're not keeping your insurance coverage. So it decreases every month to zero whenever your mortgage is paid out. The insurance you get from an agent, it's actually stays the same. There's no difference. If you take 300,000, it's 300,000 today. In 10 years, 15 years, 10 years, 30 years, up to age of 100, you can keep your coverage. Nothing will change. So here's just an example of how your insurance coverage goes down with the banks and how it stays the same with insurance agents. The next one is also important. With the bank, you have a joint coverage, which means if one person dies, they will pay off your mortgage. If the second person dies, there's nothing to pay out. It's also not a good idea. I like the option if each person has their own insurance. One person dies, his wife or husband gets money. The second person dies, the family gets money. The kids will get money. So this is also a big difference between bank and credit unions and the licensed agent option. The other one is if you change your bank or you buy another house, you will lose your mortgage insurance. If you have an insurance with an agent, your insurance will stay in place until you cancel. Why is it so important? Because if you lose your previous coverage, you have to apply again. You're older, which means the price goes up. Maybe you have some health issues, you cannot get coverage. But it's very important that every time you change your bank or you change your house, that your insurance remains the same, and this is not the case with banks or credit unions. Mortgage insurance usually expires at age 65 or 70. Our option, because I'm a licensed insurance agent, I can say we can go up to age 80, or if you take permanent product, it goes up to age 100. If you take bank insurance, you cannot change the insurance to anything else. It's only mortgage insurance. With the other option, you can change to permanent product. You can change to option where you can get the money back if you don't die, or it will be like an investment. It's a lot more flexibility than what you get from the banks or credit unions. And again, that's what I mentioned before. If you apply for a new house or a new mortgage, you have to get a new insurance, and then medical questions will be asked again. If you have a real insurance, like a term insurance or permanent insurance, the health check will be done only once, and nobody will ask you questions in the future. Banks and credit unions offer only one insurance options, only mortgage insurance. They're not licensed to offer anything else. And licensed agents offer you insurance from maybe 50 different insurance companies and 20, 30 different options. So there's lots of options that you can get. This is a critical one. The banks don't check anything up front, which means they believe you. They ask you health questions, know everything is great, and unfortunately, lots of our newcomers don't understand good English, and it's medical questions. They get the form, the person looks at the form, doesn't understand anything, doesn't want to admit that he doesn't understand. You just say, no, I'm okay, so everything is good. And then if the person dies, they will realize that actually they didn't answer the question properly. One of the dangerous ones is the smoker status. And in real insurance case, like a term insurance case, there will be a nurse, they will check your blood, they will take urine sample, and there's lots of information you cannot hide. And this is very, very crucial to understand that if you have a mortgage insurance, there's a high risk that you will not get paid. And there's even from CBC Marketplace, there's a very interesting video which you can Google where they actually did a test how many bank clients will not get paid. if one of them will pass away. And this is horrible. Like, it's very important that if something will happen, that you get paid. So now I'm done with my presentation. I know I'm over the limit. One last comment I maybe will do is that the term insurance that offers through our channel is even cheaper than the bank and the credit union, because lots of clients say, okay, great, it's great to have all these advantages, but how much more do I need to pay? It's actually not the case. You don't pay more. It's actually quite often less money, because the banks and credit union makes tons of money with mortgage insurance, and that's why it's so expensive. And chance that they will pay, it's not really high, because finally when your mortgage is paid off, there's no coverage. And if your mortgage balance is 50,000, it's easy to cover. With the real insurance, like a term insurance or permanent product, your coverage remains the same for life or for the term you pick, and that's why it makes a big difference. So Margarita, I guess I do apologize that I'm over my time, but I'm now open if we have time for questions. If not, then I guess that's what it is. Okay, I get this question asked quite often, even in my group, that they're saying, you're saying not to close credit card, but we don't like this one, and my recommendation is always just don't use it. But then I get a comment saying, but this particular credit card charging me a fee if I don't use my credit card. So what I say in this case, if you don't like it, get another one that you like, but don't close this one. But if there's a fee attached, maybe just let one of the transactions would happen automatically, like telephone bill or internet bill or something what you can, which just happens automatically. They charge you $20 or $30 or $100, whatever you pay for, and then by end of the month you pay it off. So that means you have one transaction, you will not pay a fee, but you still didn't close it. So to close a credit card is not a good idea. I know many people doing it, but this is not good for your credit history. Especially, if it's a new card, you just had it for 3 months and you don't like a different story. But if you have a credit card for 2, 3, 5, 6, 10 years, you better keep it. To improve the credit history, there is no one rule and everything will be great. I see this quite often on Facebook discussion, where I see comments saying, if you do this, your credit score will jump by 15 points. This is absolutely not the case. With some clients, the credit score can go up by 15 points. In some case, not at all. In some case, maybe 20 points. So it's really based on overall scenario of a client. If he has a good quality credit bureau, that means he has a long-term history, high limits, pays on time, never over the limit, never close to the limit. Really, there's a small thing that he needs to maybe adjust and everything will be back to normal. But if somebody has only one credit card and didn't pay the bill on time, it takes him a lot longer. So my recommendation would be, if you want to have a AAA credit history, have at least 2 credit cards or more. Don't use more than 50% of your limit. Pay your bills on time. Don't allow too many people to check your credit bureau. That's pretty much everything you need to do. And don't allow anybody to report any negative about you. Like I mentioned before, collections, like Manitoba Hydro likes collections, telephone bills, telephone companies likes to do collections. And this is something which really affects you negative. Even if you pay the collection, it just changes the status in the credit bureau from unpaid to paid, but it's still there. And for 7 years, you have to explain why. And it's just lots of issues. So that's why my recommendation would be pay the bill, do what I want, and then argue. Same with traffic tickets. Like many transactions are reported in a credit bureau. And especially now, I mentioned to you guys that starting June 1st, mortgages are now affecting your credit score. Telephone bills are affecting your credit score. So that means if you're late with your payment, and we're talking about late more than 30 days. Okay, don't get scared or panic if you miss the bill and you get the second one and you realize, oh my goodness, I didn't pay my previous one. Don't worry. Negative report goes only after 31 days. Okay, so if you're late by 20 days, not a big deal. You get charged interest rate, that's the downside, but it's not going to affect your credit score. Yes, they are. There are disadvantages to have too many credit cards, even for the credit bureau. You know, and if you have 20 credit cards and all of them with a very high limit, it's not good. Why? Because the credit bureau is concerned. What if one day you have trouble with your wife, you want to get divorced, and you're maximizing all your credit cards, and you're using the money for whatever. So you're just a high-risk client. And some lenders even paying attention to the limits. I know that some of the local credit unions, even if your balance is showing zero, what they do, they just assume that you use your credit card and you use your line of credit. And that's how they do the math to figure out if you qualify for a mortgage or not. So to have too many is not good. Really, it's not good even for yourself. You cannot control them. You can miss the payment on one of them, and that's going to affect your credit score. I have many credit cards, I have to admit. But, some of the credit cards, they're just at a certain place in my office or my home. Why? Because if I go travel, I use one specific credit card. If I fly WestJet, I use a WestJet credit card. It's just there's some credit cards that have advantages in certain places, but if you have too many, it's too dangerous. And especially if you cannot control yourself. Believe me, number one reason why people getting in trouble, why people getting bankrupt, it starts always with the credit card. And why? Because if you behave yourself well with a small credit card, they offer you a higher limit, you accept. They offer you a higher limit, you accept. And one day you just buy something that you shouldn't, and that's when it starts. Just whoever is listening to this webinar, I would do one comment which I think is crucial. If you don't pay your bill in full by end of the month, you're on the way to be in trouble. So my recommendation would be, if you have 10, pay all of them to zero. But 10 would be too much. I really think 5 credit cards, I would say it's already maximum. That should be enough. Okay, if we compare line of credit and credit cards, it's actually pretty much the same. The advantage of line of credit is it's a lower interest rate. It's a high limit usually, 10,000, 15,000, 20,000, but you can have a credit card these days for 40, 50,000 as well. But the advantage of a line of credit is that you have a lower interest rate. Usually if you're a good client, it starts around 4%, but if you're a problem, if you're a newcomer, they can give you 10% and more. So, but it still will be less than a credit card. Really, I think it's a good mix. I remember I mentioned during my presentation, it's important to have a mix. So if you have 5 credit cards, it's not so good as when you would have a 4 credit card and a line of credit. So they really like the mix of a different products. And the line of credit, it's a great product, but again, be carefully. If you use it too much and you're not able to pay off, because again, the same with the credit card, line of credit, you're forced to pay only interest rate. You don't have to pay principal. So you can have your line of credit forever. But lots of Americans do. They have the mortgages where they have to pay just interest rate. And that means they have mortgages for life. So it's not a great idea. My recommendation would be to have line of credit, nothing wrong with it. If you compare line of credit cards, I think you just need both. I don't think it's a good idea to have just line of credit and nothing else. I think it's a good idea to have both. Okay, I pretty much started to repeat the question, Margarita, because on my seminars, I always repeat my question because I have a microphone and not everybody could hear the question. Yeah, I don't need to repeat. Okay, anyways, the answer to the question is, I'm so sorry, I forgot the question. If you don't use the line of credit, nothing will happen. You're just not getting charged. There's no fee. Usually, the line of credits, some credit card some line of credit companies charging $50 flat fee. So if you have a small limit, maybe you even have a positive balance. But there's nothing wrong with it. Nothing wrong with it. You don't use it. And you know what? If you don't use it, that means you can control yourself. For the credit history, maybe it would be good to use at least a little bit, but pay it off by end of the month. But if you have enough credit cards that you use on a daily basis, there's no need to use line of credit. What I sometimes recommend my clients to do, let's say they have 3 credit cards and all of them maxed out, and they have a line of credit which is empty. I would recommend you use the line of credit funds to pay out credit cards. Why? Because line of credit is usually 5% and the credit cards 20%. It makes sense to pay them off with the line of credit. But be very careful that you don't start to reuse the credit card, and then you have a maxed out line of credit and maxed out credit card, then you're a candidate for a bankruptcy trustee, which is not good.